Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so fear of contagion last week in the financial sector weighing on markets, obviously closing even lower on Friday. And stocks breaking below those key supports at 3,900 on the S&P. VIX also exploding higher to levels not seen since October, back in the mid-20s. And then gold caught a nice strong bid, rallying pretty hard, finishing up in the green on the week, having been down. All other commodities were, however, still weaker, especially the likes of nat gas and uranium, and then copper chopping around that $4 level. Volatility-wise, we saw a big spike. We see here on the week 4 to 5 vol point rally in US implied vol. Europe and Asia also higher, but not to quite the same extent. Obviously, the weakness being driven by what's going on in the US banks. And that downside tail risk really repricing. You can see skew here up massively across the board as well, taking it back into those 50 percentile type levels, particularly in the US. S&P skew, see that is at 49 percentile, because generally when suddenly risk comes back to the table that you weren't expecting, the thing people flock to is the most liquid asset, which tends to be S&P. Now, markets are obviously very fearful about further bank runs. This situation is very fluid. However, we do think once markets feel an acceptable resolution, bailout/backstop has been delivered, then there will likely be a lot of upside reaction in markets, given how pent up the vol is and the stress is right now, given where skew has got to, given where implies have got to. We know that a lot of this put premium can get evaporated if the market gets the news that it's looking for. And essentially, the news that the market's going to be looking for is confirmation that the Fed is done, right? And we may well get that over the next couple of weeks. Okay, looking at these charts. So whilst banks have been dropping like flies, obviously, in the last few days. Okay, so we had obviously Silvergate, then we had Silicon Valley, then we had Signature Bank. So and this credit event that Hartnett from Bank of America has been talking about and been warning about, that's when you're going to finally see the bottom in markets, when we get a credit event. Okay, that seems to be happening. Policymakers do seem to be panicking a bit. So over the weekend, this backstop facility has been announced to protect depositors from losing their money. Now, US depository institutions get access to liquidity in return for high quality collateral. What does that mean? Basically, it means treasury bonds that they bought at the wrong price that are currently marked to market massively negative, but they can give them in return for some liquidity, and those are going to be marked at par because they've been parking them in hold to maturity accounts, which meant they didn't have to show those losses unless they were forced to sell them. And now they're being told, you don't need to sell them, just give them to us as collateral. We'll give you the liquidity to give your depositors their money, basically. So effectively, they're writing a check to the banks. It is a bailout to some extent. They're writing a check to the banks in the hope to prevent further bank runs, right? Because if the depositors are worried they're not going to get their money back, then you're going to get more bank runs, and this is going to continue to escalate and get worse, and more banks are going to go down. Okay, and we've seen that the speed at which banks can collapse nowadays once depositors lose confidence seems to be a matter of hours, not even really days. Okay, now futures did trade higher initially on the news overnight, but if we look at First Republic Bank, their shares are down 60% in pre-market, which is not a singing endorsement by the market that this is going to be enough to stop the panic. Right, so really things are looking a bit ropey right now. And it's because the kind of numbers that they said was 25 billion worth of backstop or something like that. It's just not enough money, right? So the Fed's going to have to come out. The government officials are going to have to come out with more because it doesn't look like this is quite done enough, right? And from what those bank shares are showing. Now, it does seem like the sharks are smelling blood in the water. This is something our friend Darius was talking about over the weekend, that, if there is fragility in the system here, then the likes of the big prop desks, the big hedge funds are going to go after it, and they're going to try and force the Fed's hand here. Okay, and they're going to really put more and more pressure on these fragile parts of the system, so that they're going to have to do something about it and maybe force an early Fed pivot. Okay, so interest rate markets have responded by taking terminal rates all the way back to 4.8, and it's essentially saying that the Fed is done. Okay, now there's a 35% probability being priced that we won't even get a hike in March. after it was looking like an 80% we were going to get 50 bips a few days ago. So this is pretty dramatic. Goldman's are actually making that call that we're not going to get a hike in March. We might get hikes further down the line, but we're not going to get a hike in March. I guess they're thinking that a hike in March would just be seen as too disastrous and the market would continue doing what it's currently doing. We'll see what happens. If the rates market's right, the question is, does Tuesday's inflation report even matter anymore? Right? If the rates market has really said, okay, the Fed can't do anything anymore, what is the inflation data really going to change? So time will tell, but we've got the big inflation number tomorrow, which was supposed to be, one of the main events of the week. But this has kind of made it, just like non-farms became a bit of a sideshow, this has kind of made it a sideshow what's going on in the banks as well. So I'm not quite sure how much the market's going to move on the inflation report. Really, I think what matters more is when we come out of FOMC on the 22nd, and see what guidance we get. Is the Fed done? What are their projections? And how does the market take that, basically? Okay. Anyway, a bit of a mouthful. Now, looking at opportunities in the market. So we mentioned, some XLV call ladders were a way to safely buy the dip last week. Kind of along the same sort of theme here. And we know we're not saying that the banks are necessarily going to rally straight from here, right? Work needs to be done. Maybe more liquidations need to happen. And more action from the government to kind of actually make people feel like they don't need to move all their money out of all the banks. That needs to happen. But the idea is, we think these are ways to safely get into the idea that in 4 to 6 weeks, the market may have bounced from the ultimate low and vols are going to start to come lower again, right? So that's the idea. So we're looking at HYG. Recent weakness in the banks and the credit concerns obviously have made HYG sell off. But you can see that it hasn't actually collapsed, and that's because the holdings of that ETF are not very financials focused. Okay, so a very, very small percentage of what that ETF is holding is related to financials, and so that's why the realized volatility to the downside in HYG has been pretty contained. Has been around 9 vol, and you can see here we've had the move down, hasn't broken that support, and also the move in yields in terms of rates. Remember, this is still a bond ETF, which is going to benefit from moves down in yields and moves up in bonds, and it's got a duration of somewhere around 7 years, something like that. That's what's kind of helped arrest that decline, basically. So whilst credit may have widened, the bond move has actually supported it to some extent. Now we do think in a bounce, if we get back into that 75 to 77 range, that's where we kind of don't need to do much, and we realize vol can really collapse. And we spent some time in there, and we weren't really squeezing too hard or selling off too hard. So we do think vols will go down if we get back into that zone. Looking at our strategy compass, obviously it's going to be saying selling puts. For those of you who know how this thing works, vols high, spots at the low end of the range, it's going to be telling you to sell puts. But right now, if you're going out banging out a load of puts in credit, you're a braver man than me, right? It doesn't really, it's not the right way to risk manage, right? We look for opportunities to fade vol, but we want to do it in safe way. So even if you did want to sell puts, I'd be saying sell put spreads. So you've got a contained loss, but I don't even really want to do that because the risk reward doesn't look amazing. What I would rather do is the trade I'm recommending is a call ratio structure. All right. So the idea is if we get a bounce here, we think, we might get a knee-jerk bounce, but then markets can settle down again back to the level that they were at, 75 to 77. The volatility here in April has popped. The carry is massive because this thing just isn't realizing. So we want to get into a position where in a bounce, we get short vol and that vol's got room to come down. Okay. So that's the idea. So call ratios are what we're looking at. Now, the way we identified this was actually by looking at our realized skew and our skew charts at the weekend. We can see the upside skew. The green line shows you where the implied vol is for the upside. And if you compare that to any level of implied vol that we've seen in the last 3 months, it's miles above. So if vol's here right now, if we were to bounce in terms of the market that way, we would expect vol to collapse again. And this green line is where the vol is currently marked. So we think there's a lot of downside in the vol from like 12 vol all the way back down to 8 vol. So that's 4 vol points of potential upside. Okay. So the way we would do that is a call ratio structure. All right. That's it for today. Thanks a lot for listening. Catch you all tomorrow.